Check the markets here. Told you this bounce is trying to happen in tech. 2/3 of 1% for the NASDAQ. That's where we really have been focused. We're right around 7,300 for the S&P. Qs are down 4% this week. That's notable. NASDAQ's down a couple of percentage points this week. The SOX has been down for the past 5 days, the epicenter of a lot of the selling. So what's going on? That's the question we want to ask. Jonathan Krinsky, BTIG says today, at this point, our assumption is that this is still a positioning unwind, not a regime change. But we don't think it's fully run its course. As a result, we would suggest you remain seated with your seat belts fastened.
I can hear you okay, and I've got program.
As we expect more near-term turbulence. What do you think?
Yeah, I think that's fair. It's too soon to say, oh, that's it. We saw the top of tech, never going to be as good again. People have made that call over the last 3 years on multiple occasions, and then pie right in the face. So Jonathan's a technician. I don't think a technician wants to say a rocky 30-day period is like the end of what's been a 36-month bull market. And I don't want to say that either. However, Mag 7 are now, as a group, negative on the year. We had blow-off tops in Korean stocks, memory stocks. You see the semis bouncing 3% today. Not a ton of conviction, not a lot of volume behind these moves. The software rally that added fuel to the fire, well, that's unwound very quickly. At their peak a few days ago, the software names got to within 11% of their year highs. Now they're backed into a 23% drawdown. A lot of broken hopes and dreams in that space. So I'm looking at the action in Oracle. I'm looking at some of these unwinds continuing to unwind far below where I thought the unwinds would go. And I'm basically sitting here saying, why tech right now? It's too messy, technically. There's so many other things that are working. I want to spotlight. We talked about Casey's. This is both a Porterhouse constituent and in the best stocks in the market. We've been talking about it all year. It's literally pizza in Nebraska. I don't even know what the story is here beyond just higher gas prices, more revenue. Look what the market did to this stock yesterday. Went up 15% on earnings. It is the best performing name this week in the S&P 500. There are a lot of Casey's general stores in the tape. We don't need to just be minutely focused on the microns every single day. I think there are a lot of ways. Starbucks is up 7% over the last week. Darden's up 8%. Best Buy, believe it or not, up 7%. Kenvue up 7%. There are places to make money. There are winners in every sector in the market. Insight, a biotech, up 7% over the last week. So that's what I'm focused on, Judge. I'm not as focused on how long will this tech unwind go for. It hasn't gotten me out of bed yet. They're not down enough for me to say, that's it, we're good. And I don't think things were as dire as the bears do.
I think Jenny, B of A largely agrees with, the views of Josh. Too early to buy beaten down tech, they say. It's time for value. As he points out a number of stocks, that's really the epicenter of the debate right now. Buy the dip in tech or buy other things that are available at pretty reasonable prices that have all but been forgotten in this huge run up.
Right, and I think there's been a lot of movement into that already. So for me, I look at the portfolio and I have stocks that are up like 60%, 80% on the year. And there are things that we don't talk about, like Ryman Hospitality Properties and Lamar Advertising, which does billboards, or in our growth strategy, Materion, which is a materials company, or Albany International, which is like carbon weave fibers. So there's a lot out there. So I worry a little bit, Scott, that the positioning, the move into value has already started to happen, and that some of that bloom is off the rose already. I think there's more to go. But when I think, I totally agree with Josh, and I think too, when we think about Mag 7 being down, I think of it more as flat. And I think that is really healthy. There is, to your point exactly, there's so much messiness going on right now. They're going from cash flow producers to cash flow consumers. The whole world's changing. So I actually feel really good about them just being flat. And I look at this as maybe not an either or, but fine, let them consolidate, let them grow into those multiples, which they're doing. I think it's incredibly healthy. And if you happen to have new money, maybe just start to continue to broaden that out, even though it's already happened. But I don't think you're going to get I don't know. I look at it and I'm like, shoot, some things are up so much. I would have rather entered them 6 months ago.
Mega cap's not flat. I mean, you look at the percentage that they're off their 52-week high.
Yeah.
I'm talking about the Mag 7.
Okay.
Microsoft's 27% off its 52-week
within the Mag 7.
high.
You're right.
Meta's down 27% off of its 52-week high. Amazon's down 12. Nvidia's down. They're all down considerably off of their 52-week highs. It shows you the selling that's taken place in the very top heaviest part of the market. I don't know how you, Rob, feel about opportunities to buy some of the dips at this point. I think we're all kind of waiting for the dip buyers to show their hand, and there's not a lot of conviction yet, as we said off the top of the broadcast.
I view that as a really healthy thing, that there's not a lot of conviction yet. But again, I would fall into the camp that many of these have not fallen enough. And keep in mind that we own a lot of these. We are talking to clients about building positions into our growth portfolios, into our dividend portfolios at right times. And sometimes that takes a 5% reset, which the only area we got that was in tech, right? And so we took advantage of that. We'll talk about that later in the show. But it was much more surgical than typically. There's no doubt that this has been an earnings-driven market year to date. And what's done well should have done well, because that's where the implications of earnings growth have been the highest. What's interesting, and what they were talking about, is the re-rating that we see. 40% of the stocks in the S&P are down for the year. It's just a really interesting dichotomy. So I do view it as a little healthy that this is happening.
Why don't you think that these names have fallen enough? If you point to the fact that it's been an earnings-driven move to begin with, the reason why the Microns of the world and the Marvells of the world ran up the way they did straight up and to the right is because their earnings presented a new paradigm for those stocks.
Correct.
They forced people to understand that they were underestimating the earnings momentum that they appeared to have. So if they've pulled back, what makes you believe that they haven't pulled back far enough?
Because the tokenomics discussion has entered the chat. That's the real answer.
Here is the thing that I think. When you price a terminal value and you price it off an exceedingly high earnings period, which some of those earnings were driven by sales, right? There was still healthy organic earnings growth, but there was still profits being brought in by sales of privates. And I think sometimes we can pull forward enthusiasm into price, if that makes sense.
It does. Well, is that what we did with the Microns of the world?
We did briefly. Now we're going to re-rate and re-underwrite for what I believe is a more sustainable earnings growth trajectory. And I think it's going to be a little more broad-based. And I think you can still be constructive on equities, but let's be honest, we're entering a seasonally weak period. You have geopolitical tensions that are pressing on rates. You're in a quieter earnings period, and so usually you have something come along to save the day in the interim. You have midterm elections coming up, and you have a couple big IPOs that are coming, and the reality of it is supply is coming onto the market. And so this is just digestion. It's not negativity. And I want to react really to Oracle, for example, announcing a spend.
Yeah.
If you run a private company, and this is why I love investing in private companies, you don't need to manage quarter to quarter. So when you see a long-term opportunity that is going to change the ROE characteristics forward of your business, as we do all the time at New Edge, we will make that investment even if there's a quarterly impact. A company like Oracle is going to come out and say, we are committed to this spend because we know this is an arms race and we are going to win. They actually had good numbers. I don't own Oracle, but I'm using them as an example. And the market punishes that. Guess what? That gives you an opportunity to get in there and think about that.
You could say it's rightful punishment. I mean, by these equity offerings, it's dilutive, obviously. People had already been concerned with Oracle's debt raise. Now it's an equity offering. The point being, their spending machine is ramping up, not down.
May I? The fundamental thing that's changed in the last 2 weeks is this discussion about the price of compute.
That's right.
The value of these workloads. And we're now going to, I think, the second half story. You'll see this desk closing bell. It'll be filled with people saying what I'm about to tell you right now. What's going to happen here is we're going to start to delineate between premium usage of compute versus cheap, dirty usage of compute that should not require the same pricing on compute and the same amount, the same volume of compute. So me looking up a recipe for fettuccine bolognese should not be taking place in the same part of the data center using the same chips as NASA trying to calculate the trajectory of a satellite launch. But that is literally what the AI build out has started as. It's just this,
but it's starting to bifurcate.
Correct.
You're looking at it
right. That's exactly right. And now what we're going to start to see is haves and have-nots. We're going to see Adam Smith economics start to weigh on all of this activity. Companies starting to get rational about, wait. Why are we underwriting all of this AI usage that's just like blanket, yeah, sure, put whatever you want in the query and we'll consider all that compute the same. And so what you're seeing in the stock prices, which is, we're not a tech show, we're a stock show. What you're seeing in the stock prices is we think, are we really going to have memory demand on the scale that we thought we would? Are we really going to have chip usage in the same way that we have? And all of a sudden, as rational economics take hold, you're going to start to see a rethink in all of this earnings growth and whether or not we think it's going to play out.